to get in the nitty gritty of things, we do most of our short-term stuff was we'll hold on our balance sheet. We manage the draw process. We manage the servicing of those loans. We continue to have a relationship with the client as we fund their draws and their rehab budgets. There is a thriving secondary market for the RTL space. We prefer to hold on to it. It just makes more sense for our fund. However, in the fund, we do not want to hold 30-year paper. That's not good for return.
While most professionals chase the same overcrowded investment paths, Financing the Future pulls back the curtain on a lending strategy that thrives in expanding regions and offers a level of stability banks just can't touch. Welcome to Streams to Impact, brought to you by Dynamo Capital. I'm your host, Dr. Allen. High-achieving professionals eventually reach a point where working harder no longer creates more freedom. The real shift happens when your capital begins working independently of you, building multiple streams of income while you stay devoted to the work you love. This show opens the door to the kinds of private structured opportunities that have helped institutions and the ultra-wealthy grow stable, long-term wealth far from the volatility of public markets. So take a deep breath, settle in, and let's step into today's conversation, Financing the Future, how Dynamo Capital fuels high-performance real estate across the Mid and Mountain West. Just a brief disclaimer. All information shared on Streams to Impact is for educational purposes only. It is not to be construed as investment, financial, legal, or tax advice. All investments incur risk. You should not invest if you are not prepared to lose 100% of your investment. You are always encouraged to consult your legal, accounting, and tax advisors before making any investment. Our guest today is Matthew Medrano, co-founder and chief revenue officer of Dynamo Capital, a leading private money lender serving the Mid and Mountain West. Dynamo provides the kind of fast, reliable, relationship-driven capital that allows experienced real estate operators to move decisively in growing markets where traditional banks often lag behind. Matthew has built a reputation for understanding where growth is headed and how private lending can support strong, stable returns for both developers and passive investors. Today, he joins us to break down how private capital fuels high-performance real estate and why these emerging regions are so compelling for wealth developers. So welcome, Matthew. Glad to have you with us here today. Let's just begin with, if you would just share with us a little bit about what your inner philosophy or your life experiences most shaped your approach to investing and leadership. Specifically, how did seeing a need for complex structuring in the Midwest drive your decisions?
I think the best way to answer that question is that there's a real entrepreneuring and bootstrapping approach in the Midwest, and kind of a do-it-yourself attitude that I certainly have and that other Midwesterners share. In our particular sector, there's very few private lending and investment funding options that are made their way to the Midwest. It's very dominated in the coasts, and there's not much action in the Midwest, and so out of a necessity to find better products for our clients, we were working with these lenders that were on the coast, and those lenders are built for clients on the coast and working with clients and investors that have projects out there. They don't need to come to the Midwest. They have plenty of business out on the edges of the country. And so instead of trying to force that round peg into a square hole, we just did it ourselves. That's ultimately why we started the fund, why we started the investment platform that we did. And it's helped out a lot of Midwesterners. It's brought liquidity to the Midwest that hasn't otherwise been available at scale. It's dominated by local banks and credit unions in our market. And especially at this time when local banks and credit unions are shifting their appetite, it gives rise to an opportunity for Dynamo to step in, fill gaps that were otherwise either being filled in less efficient ways or not being filled at all. And in some cases, educating people that there is actually a gap and that there's an opportunity that you're not taking advantage of. So It's been a network we've built out over community and an opportunity for us to partner with local investors that have otherwise not had access.
Well, it sounds really interesting, Matthew. If you could just share with us, what does Dynamo actually do? How do you function between the lenders and credit unions, banks, and the borrowers?
Sure. So Dynamo Capital is a fix and flip and DSCR funder of single family 1 to 4 unit properties. That's our main focus. We'll look at really anything that's real estate backed, but our main target is to work with single family 1 to 4 unit properties. That's our bread and butter. It's our fairway. We know it really well in the Midwest. We're in Wichita, Kansas, by example. Everybody here works with their local banks and credit unions. My grandpa, for God's sakes, whenever he was alive, even as I was a lender, he still worked with his bank and credit union, not me, right? And so the market is shifting in that sense, and that's starting to phase out, and we're getting more educated and more mature in our market about the options that are available to us. I mean, we've seen a giant growth of private lending that's happening here in Wichita. But back to what we do specifically, we focus on, like I said, single family 1 to 4 units, fix and flip properties, and rolling them into long-term financing. For example, in Wichita, if you wanted access to that type of capital, again, you were either going to a local bank and credit union where you needed to show W-2s, taxes, all the standard bank things, or you were working with a broker, which is what we were doing before, or what we were before, brokering those deals to larger institutional style investors, names that are fantastic in the space. We know them. We work alongside them, but they've just chosen not to invest in the Midwest, which is totally fine. It's a very particular market. You kind of have to understand the nuances of it. For example, in Wichita, it's very difficult to convince one of these bigger firms that the $75,000 valued property here in Wichita is actually meaningful, worth something, and it is not a cardboard box, because that's about all it gets you. $75,000 on the coast these days, right? That's just right. The discrepancy of value is really hard for a lot of these lenders to wrap their mind around. And funny enough, as a lender today, I recognize like the cost of human capital that it takes to produce these loans. For this, typically lenders are based on, or they're compensated based on the total loan amount. So yeah, of course, if I can do a $75,000 loan or a $750,000 loan, of course, I'd like to 10x my return on that human capital that I'm spending. Right? That's not our strategy. We want to focus on the Midwest, serve those who are otherwise underserved in the market, and we've kind of carved out our own little niche of the market. We're happy in the Midwest. We're fine to splash around in the shallow end of the pool out here.
Well, over the years since you have been doing this and really serving the Midwest, how do institutional lenders view you in this game? Are they willing to cooperate and come to you when they can't do something, or do they see you as a predator?
I don't think it's a predatory market, or, competitive market in that sense, which I've been very surprised with. I've been very happy about how we've been welcomed into kind of that brotherhood of private lenders in the industry. I'll tell you, we just came back from the AAPL conference, which is the American Association of Private Lenders, largest private lending organization in the country, where there's a ton of camaraderie and a lot of sharing and a lot of collaboration. I've been interested to see that this is really just kind of a big chain of bigger fish above you, right? That want access to the work that you're doing and they want to be able to fund. And there's a lot of offshoot type businesses that come together to make this work, whether it's appraisals or title work or lending to lenders through warehouse lines and credit facilities and whatnot. So the biggest thing that I would say about how people have seen us is fresh exposure to a market they otherwise can't get to. And not just exposure, but skillful exposure to that market. It's not just a coastal company that decided, you know what, nobody's over here. Let's just go figure out Wichita, Kansas. In the Midwest overall, it's Midwesterners who know what they're looking at that are, creating their path there. And I feel like we've been welcomed with open arms of like, hey, like, tell us what's going on out there. You guys are taking care of us. We're trade partners in a lot of ways. For example, in our DSCR product, we're putting that in the secondary market. The secondary market right now doesn't have much exposure to the Midwest. We're creating that exposure. We're making a market in its own way. So it's been a really collaborative approach that these partners have taken. And it's funny, over the past 2 years, we've gone from nobody knowing who we are to people starting to kind of like, oh, I recognize those guys. We're fairly recognizable partners ourselves, right? But beyond that, then, you start to know the name. You start to understand where we're at. Oh, those guys in the Midwest. Still a little bit uncomfy about people knowing that there's action out here in Kansas. Just let me do it quietly over here, and we'll keep our heads down. But no, it's been really nice. We feel really comfortable in the position we are in the market. In that, sure, like a bigger firm from New York wants to show up here. Good luck, right? The Midwest works with Midwesterners. We're going to take care of these borrowers. We know them intimately well. And it's just there's a confidence and arrogance, whatever you want to call it, that we know we can connect with these borrowers and produce the best things that we can for them.
Yeah. So you focus on fix and flip. So I'm assuming that these are short-term loans, but you're still able to sell those on the secondary market?
Yeah. So to get in the nitty gritty of things, we do most of our short-term stuff we'll hold on our balance sheet. We manage the draw process. We manage the servicing of those loans. We continue to have a relationship with the client as we fund their draws and their rehab budgets. There is a thriving secondary market for the RTL space. We prefer to hold on to it. It just makes more sense for our fund. However, in the fund, we do not want to hold 30-year paper. That's not good for return. We are passing back really nice coupons on the 30-year stuff, high 6s, low 7s. That is not an equation to make a high yield on the fund. And so we sell that into the secondary market, but that's a little bit behind the scenes of how we operate. But on the RTL side, there's a thriving market. It's great. It's starting to get more liquidity from an institutional perspective poured in. I mean, last year was the first rated securitization in the RTL space, which is really exciting for the space. But it gives rise to like a tighter box, more not regulation, but just higher minimum credit scores. What do we want to see the loans look like, et cetera, et cetera. And so as the box becomes more formalized, it gives more opportunity to a private lender focused on nuance and niche markets, a little bit more space to be flexible and say, hey, there's securitization group over there thinks that a bad credit score starts with a 7. That's not true. That's the 690 is still a good deal, right? It's still a good credit score for us to work in. You can still get an FHA loan, for God's sakes, like that. We're happy to fund those deals, and it's all nuanced and risk adjusted and all those things that make our investors comfortable and make us comfortable from a collateral perspective. So yeah, it's a welcome sight to see more liquidity pouring in. It certainly is increasing the value of hard money. Whether you call it hard money, private lending, mob money, whatever you want to call it, right? It's I hear a lot of different terms from a lot of different clients. I was listening to a podcast on that our legal team does, and it's whatever the client calls it, right? It's make no mistake about it. We're here to serve the clients. If the clients want to call it unicorn money because we give 100% of the needs, I sell unicorn money. I don't care what they want to call it. We do a good job with the loans that we do, and our borrowers do a really good job deploying that capital into their projects and creating successful exits.
You specialize in the fix and flip, the short-term rentals, but you really help individuals collateralize over a number of different properties, from what I understand, depending on how complex their portfolios are and what have you. which is an area in which you kind of shine and you specialize. So talk to us about how it is that you really help individuals to really access that equity that could be challenging in a traditional kind of market lending place.
Yeah. So, look, it's a little bit anti-brand to say that there's not anything special that Dynamo Capital does, but there's really nothing that we've invented ourselves. Lending has been lending from the beginning of time. In terms of how we do it, it's really just our boutique approach. It's dedicated. I'm hard pressed to even call what our team does as sales. It's not order taking either. It's crafting deals that make sense for the borrower and meeting them where they're at. Whether we charge a certain origination fee and rate, or we shift that origination fee to all rates. We do zero origination fee and higher interest rate loans. We do lower interest rate, higher origination fees. It just depends on the cash structure of that client. It depends on where they're at in their deal. Ultimately, what Dynamo sells is scale and successful exit. In our first, we started at the tail end of 23, really did a beta test to kind of get running and got everything in the fund up and cooking at the top of 24. I would say end of Q1, top of Q2 and 24 was when we started being Dynamo. Because, my partner, Justin, and I, we were residential and commercial mortgage brokers prior. We had never serviced a loan. We have never administered a draw before. We had never gave out investor distributions and returns, right? We were learning how to run a fund and a lender all at the same time, kind of trial by fire. And so we had a lot of things that we needed to figure out. How do we want to craft this company and start it from the right square as a square one? And so, we started taking in our first real dollars, top of Q2 and 24. Since inception, though, we've now eclipsed the $100 million mark in total loan volume, which is phenomenal. I would have never imagined that we would get to that point. So it's, things have changed dramatically for us. When we started, our goal was to be maybe a $10 million fund, $10 million fund that we thought was, I can't imagine we could spend more than $5 or $10 million in Wichita at a time. And, today we've eclipsed over $100 million in total assets under management at the fund, kind of by accident, kind of by growing with the clients. We're not growing for the sake of growing. We're following where these clients need us. Back to how flexible we are and what sets Dynamo apart is Dynamo is known for 100% loan to cost lending. That's considered fairly aggressive in our market. Not just fairly aggressive, I would say it's probably very aggressive. But I think that's to somebody that doesn't necessarily understand what our actual book looks like. Most of our loans are at an average LTV of 68 or 69% right now, right? And that's hardly aggressive. It is just a nuance of the Midwest that 100% loan to cost is a little safer and a little, the 5 or 10% in the Midwest really means $5,000 or $10,000, not, tens of thousands of hundreds of dollars, right? That the coasts vary in, and so that's why we like the Midwest. It's a fairly, knock on wood, consistent and safe market for us to be in, with reasonable prices and safe valuations have trended nicely, as opposed to these big, just crazy swings of all the appreciation, depreciation that you're going through in the market today. So that's why we like the Midwest. It's why we feel comfortable being for example, 100% loan to cost. Our main strategy is to provide scale and speed to our borrowers. We're in a situation where the market is ripe for the picking of either distressed properties. Unfortunately, foreclosure rates are up dramatically in the market. Our investors are there to purchase those. And so what we really like about it is we're working with individuals who are professional flippers and rental holders that are doing good things for the community, revitalizing communities, whole neighborhoods in some cases, building new properties, building new developments. We feel like we are doing something that's meaningful. It's difficult to convince somebody on the surface that we are an altruistic debt fund because historically that those two things don't line up all the way. But yeah, it's what we're about. We want to make sure that we're focused on the markets that we're receiving capital in. For example, we have a good chunk of investor capital that's coming from Wichita, obviously. We also have a really meaningful chunk of investor capital that's coming out of the Front Range area in Colorado. So we opened up an office in Denver and started to build a little hub out there. We have a phenomenal sales team that's being built out there and a good network of trusted investors. Obviously, with the investors that are coming into the fund, there's naturally they're talking about deals that could be done within the fund, et cetera, et cetera. So it's just kind of organically growing out there. But yeah, it's been a huge hit for us. Even in a market where a little people are a little bit less hot on Denver, there are certainly still pockets of the Front Range market that are strong. Boulder, for example, we're heavily active in Boulder, and it's been really good for us. So not just broad stroking saying like a big firm like we want to get out of the Denver MSA, we're gonna slash leverages and we're gonna spend less there. No, let's just be more targeted about the borrowers and clients that we're working with out there that have good projects. Ultimately, this is asset-based lending. Find good assets, value it correctly, fund it accordingly, and you're going to be fine. And that's kind of been the philosophy of Dynamo all the way. And yeah, especially as like other lenders fall out of those markets or pull back, we'll be there to step in and partner with those clients. These deals are being done in every market, whether people know it or not. Private lending it's always going to be a thing, right? Regardless of how the market shifts, if it becomes more of a rental market, great. We're going to do more rental loans, right? We'll do less fix and flips. We'll do fix and holds. If the market shifts to 2% tomorrow and rates are rock bottom because we're back in the COVID era pricing, great. We're going to do more flips because there's going to be more purchases. It doesn't matter how the market shifts. People are still going to need housing. People are still going to need well-renovated spaces. Our borrowers are going to be there. We had this huge boom in Wichita during the rates being so low, and everybody got into flipping and wanted to control their own destiny, right? Especially if I can't work, I want to be the guy that's owning the houses and people are paying me for rentals. So the market's going to continue to be there. We'll continue to serve it.
Yeah. Well, I can see why you found a sweet spot in Wichita. Most people don't even think of Wichita. And when they hear of Wichita, Kansas, they probably think more of the OK Corral and Gunsmoke than they think of a thriving modern city, which actually, when I first went to Wichita, it really surprised me how dynamic the city is. And the university there, I was doing some research at the time, and it was one of the best organized libraries I have ever been in. I was just really astounded. And then on the campus there, I was just blown away at the diversity of the international student community. It just blew me away. So yeah, I can see why you would find a lot of opportunities that no one else would look for in Wichita. It's just that kind of city.
It's easy to pass over. It's a mid-major market that, when you think Kansas, you think Kansas City. Majority of Kansas City is not even in Kansas and Missouri. Wichita had a really big boom during the early 2010s. They went on that big Final Four run for the Shockers, the WSU basketball team here. We don't have any big sporting events. It's Wichita State. Wichita State basketball is the professional team around here, is what I say. And they've been, for example, we're the season presenting sponsor of that group. We're very entrenched in the community. Very excited about what Wichita will be. I went to school in Iowa during the early 2010s. And so I saw Des Moines really kind of hit a big boom. I think I'm very bullish on Wichita being kind of a Des Moines 2.0. especially as there's more floods from the floods or people flooding out of the coastal areas into the Midwest. And people are going to start to find out that Kansas ain't a bad place to live. It's getting cold. I'm already in a hoodie, but it gets hot. But it's an easy spot to get around. I mean, you're 2 hours from anywhere you need to be by plane or by train, by car or whatever. So it's it's a good spot. I'm born and raised here. I love it. I'm really happy about starting a company here and building it out the way we have. But I think that's true with the Midwest in general. And that's why we're expanding into that.
Well, you had talked about altruistic lending. So what does wealth mean to you personally beyond numbers, and how has that really defined how your company has evolved, and how do you help sophisticated investors to really look at this from an altruistic perspective?
Yeah, so I think first off, it's a good question. I think it's really been a guiding light for how we run Dynamo. From how we run the operation, altruism has been an easy thing for us to guide how we operate. We've got, for example, one thing that's really unique about how we operate is our sales team is not paid on commissions. Our sales team receives a salary. We bonus the group accordingly and whatnot, but everybody is given what they need to be able to not just survive but thrive here in town. My first question is, what kind of target earnings are you looking for? And let's get you to that right away, and then you can go out and do good deals. The good thing about that is we don't have a sales team that's pushing bad deals into the fund and then putting the fund at risk because they're trying to make their mortgage payment. We don't want that at all. We want to make sure that they're taken care of in a way that's meaningful to them. Still leave some incentive to go out and produce good deals and everything. But at the end of the day, sales teams are already intrinsically motivated. I want to take the pressure of them being able to provide for their family out of the way. That's what I wanted as a sales individual. And so I want to make sure that we reciprocate that to our team here today. There's a lot of times when you have to make decisions at the business. Doing the next right thing has always been the easiest way to make those decisions. And all the things that I expected to struggle with as a business owner are not the ones that I struggle with. And the things that I didn't think would be hard are the ones that are the toughest. So, that's a really amoebus answer to that. But doing the next right thing has always been the right answer for us, which sounds as basic as it is. But a lot of the times that stuff is really obvious, what you should be doing and what you shouldn't do. And how do we do something? I mean, we've done deals that are rescue deals for borrowers because they were working with a private lender that, it's hard to tell the exact motivation, but there was a foreclosure that was written all over this thing and we needed to save for them, and we did. We want to take care of clients, make sure that they're not, getting taken advantage of. Private lending is a fairly unregulated space, and it can be predatory pretty quick. And so we're happy to step in and save deals and save situations for borrowers. From an investor perspective, so we have two investors really that we serve. The clients that are investors that are building portfolios that are, fixing and flipping and actually swinging the hammer. The altruism piece of that is really straightforward, right? Obviously, it's a profitable business to be in, but they're doing something meaningful in revitalizing the community. So it's a really easy thing to be excited about. In most cases, the niche that Dynamo fills is to the investor, the borrower is, hey, I've only been able to do 3 of these a year because they're so capital intensive with my down payment and the monthly payment, and then I got to fund the rehab, and it's capital, and I can only have so much of it, and I have to spread that out over these deals. What Dynamo serves for those clients is the ability to reduce the amount of capital exposure per deal, so you can do more and grow your portfolio that way. So in those cases, we're helping people, grow 5-10 years faster than they expected to, right? That's an arbitrary number, but you get the point. Or in some of those cases, help somebody take the leap from being a weekend warrior to a full-time investor that's doing this. We're not reserved for just, the 10 property a month investors. We work with first-time investors. Now we've got a hawk eye on those, and we're showing them how to do it. But we're also teaching them like the best business practices to do it. A lot of these guys, they're really good at running a shovel, but they can't run an Excel spreadsheet to save their life, right? So we professionalize that. We teach them what they need to know. That's been a really good niche for us to fill in as well. We didn't get to the top of the tree and then pull the ladder up behind us and say nobody can come with us. We're letting people come up, and we're showing them that path. We've built a good network of other investors that help coordinate and bring them along in some kind of mentorship, if you will. And then from the LP side, the investor side into the fund, we have aggressively gone after any conflict or negative incentive at the fund. Again, sales guys on really no employee on a performance basis is compensated. The way we've structured the fund, we split all the revenue that comes into the fund, aside from a small admin fee that covers pass-through costs for us. We split that all between the investor and the general partnership. That's fairly unheard of in how we do things. If you're familiar with how funds are typically structured, generally speaking, funds pass through the interest revenue to the investors, or some split of the interest revenue, and keep the origination fee for themselves because they're the ones that originate the loans. We split all of the revenue in the fund 50-50. It's truly a partnership between the LPs and the GPs, which we're really proud of. It's been probably the biggest comment that we get is it's a fairly innovative way to go about it. It's a very true partnership between us and the investors. We wouldn't be here without the capital from the investors. And for that, we're willing to be generous on how we compensate them. And we've always been, give us the slice of watermelon as opposed to the whole strawberry. Doesn't make sense to lose track of what can be done. We're not trying to take anybody else's piece. We're trying to grow the pile all over. So that's kind of been how we approach it. Trying to do the right thing at every level. It's difficult, right? You got a lot of moving parts, a lot of clients, a lot of scenarios. It's tough to, every day it's the same thing for us in a way, right? You're not a loan number, but the loans do have numbers and they've got stats and we've got guides and all those things. For our team, the thing that I'm most proud of is they do a phenomenal job of every time that borrower calls in, is the most important thing they're doing right this second to work with that client. The client, it's the biggest thing they have going on right now. They got $250,000 invested in this project. It's meaningful to them. It's the biggest thing. It's their business. It's their livelihood. It's if they're going to be able to go on that Christmas vacation this year because this successful flip, or it's not. So we have to approach each of those conversations, interactions with gusto and show up for work each time with those guys. So really important that we maintain that level of intensity at all fronts of our business and care. So yeah, that's Dynamo from an altruistic perspective.
Well, thank you, Matt, for being with us today. We have been speaking with Matthew Medrano with Dynamo Capital. And today we learned that experienced investors need solutions that go beyond the checkbook, lenders who can handle portfolio level structuring and understanding the Midwest market opportunity. Matthew built Dynamo to solve those complex lending problems. So if you have a complex portfolio and need a lending expert, take action now and you can submit a loan request, or you can have Dynamo review your portfolio to see where equity is sitting untapped. You can find Matthew at www.dynamocapital.com. So we thank you all for joining us on Streams to Impact today, brought to you by Steve Talker Capital. We help high-income individuals find the path where their wealth works as hard as they do. Access our educational gift beyond the paycheck, the Financial Clarity Compass. It's the instructional masterclass and exclusive bonus that simplifies and accelerates your path to lasting financial freedom. And you can claim your gift at www.go.steedtalker.com /beyond-paycheck. Until next time, invest with integrity and impact, and we'll see you in the next episode.
Thank you for tuning into Streams to Impact, brought to you by Steed Talker Capital, a company empowering passionate professionals like you to develop multiple streams of passive income built on solid passive real estate investments. As a significant part of our endeavors to make a cosmic and meaningful impact for this world, Steed Talker Capital contributes significant portions of our profits to activities and organizations committed to better understanding the equine. These endeavors attempt to enhance the treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures great and small flourish abundantly. If you are ready to learn how our passive investors have earned an average 33% annual return on their investments, schedule your complimentary passive income to Prideful Impact consultation. Obviously, we cannot continue indefinitely to offer these valuable consultations for free, so grab your passive income to Prideful Impact consultation while you still can. Go to steedtalker.com/passive